We've seen a big spike in aluminium because of the sanctions that have affected Rusal, and we're seeing ripples across the commodity market. Are these ripples something we should be concerned about?
I guess we'll see. We want to be cautious and see what happens. But I think the broader story here, which is like one of the key themes for us, is we're in 2018 facing a macro environment that is materially different from what we've seen until now. And the key feature of it is like increased uncertainty, macro uncertainty. And I think this is a manifestation of that. We're seeing like trade actions. This is not trade uncertainty. This is trade actions, sanctions. And now we're seeing markets reacting to that.
This is another chart, Jean, I want to show off as well. This is a great chart that highlights how industrial metals are booming, outpacing these smaller gains in the broader commodity space. Contrary to precious metals, Jean, we're hearing warnings from central bankers. We heard from various Fed officials last night, the IMF meeting. It's clear there's a concern about a possible trade war, but the tone has been dialed down a little bit this week, especially at that Trump-Abe meeting at the White House. What are your sort of worst case scenarios going through your head and the best case scenarios going through your head?
The worst case scenario is, escalation, actual action being taken. We're talking about them if they start to be, enacted, these trade measures. It's not only about the trade and the specific sector being affected. Trade has been a very powerful catalyst for this synchronized expansion that we're going. This is the most, globally integrated expansion we've ever lived through. And in our view, the reason why we were very constructive on the remaining leg of this cycle was predicated on trade. And as a result, any of that noise could have an outsized impact, and in particular through the confidence.
Yeah, and the remaining leg of the cycle, what's it looking like now? How long? What's the sort of the tone of the remaining leg of the cycle looking like?
So I think if we have the trade risk that is being contained, we are not seeing massive excesses yet. We're seeing slowly eating up of the global economy. So that gives us time. We say like the time to the next peak should be in years, not measured in years, not in cycles, not in quarters. That starts to be more questioned if we start to see the trade noise become.
And the implications across the asset space are of this thesis?
If things are continuing, I think we're in a world where, like, even though risk will not be as rewarded as it has been over the last couple of years, we still say risk is rewarded. But at the same time, the risk is higher. This is real risk, macro risk, and so this is an environment that is slightly less favorable for taking risk while these uncertainties are still looming.